bit about gold production and cost, etc. So just real physical cost of production for gold. What's your summary observation?
We don't at Edison. We don't do detailed cost curves. Anecdotally, I think talking total cash costs, there are not actually that many companies that are producing below $900 an ounce. And that's before CapEx is taken into account. There certainly are some, but there are not that many. Excuse me. So I think I think there is a feeling that where the price of gold is at the moment, there are not many companies that are making much money from that. And certainly by the time you start taking CapEx and depreciation and all sorts of other things into account, margins, I think, are quite thin. There's always the hope, of course, that costs will go down in future, but that is a hard road to tread, and it's not an easy thing to do in what is otherwise generally an inflationary world. The mines, as we speak, from here on in, will gain a dividend, if you like, in the form of lower oil prices, and that will feed through to fuel prices, and fuel and energy are a high proportion of most mining companies' cost bases, so they will get a benefit from that. But my feeling is that the middle of the cost curve is probably $900 and something an ounce.
So what happens if gold goes below 1,000 then?
Well, you'll see a lot of mines go on to care and maintenance. It depends. I mean, if it just spikes down over the course of a day or a week, then you won't see anything happen. But otherwise, all other things being equal, if gold goes down to $900 an ounce, you'll see companies, first of all, making losses. They won't immediately close their mines because that's an expensive thing to do, but they will have a sense of how long they can put up with that for, and they'll cut all the costs they can. Of course, it depends on the reason why gold has gone down to $900 an ounce, and if it goes down to $900 an ounce, but oil goes from 60 to 40, well, then that's where your relief will come from. It all depends on what your local currency does as well, because if your local currency drops off against the cliff against the dollar, then that will give you relief as well. So, but all other things being equal, if, as they are today, and gold went through $900 an ounce, and you would see quite a lot of the world's productive base, I think about half the world's productive base probably underwater, and the rest of them making sort of fairly slim margins.
What do you think is pushing gold prices down
then? At the moment, I think it is negative investment sentiment towards gold, which is causing sales out of ETFs and general sales of physical gold, and indeed paper contracts as well, out into the market. Is the old saying of there being more sellers than buyers. And I think that is in expectation that this is a normal recovery from a normal sort of recession, and therefore the next thing that's going to happen is interest rates are going to rise. And I don't think, I stand against it, I don't think that's going to happen. I think this is not a normal recovery from a normal recession. I don't think there is much scope for interest rates to rise, because if they, first of all, you'd have to say, why would they rise? And they're not going to rise, in my opinion, unless inflation starts going up. And even so, can either banks or governments afford interest rates to rise? And probably the answer to that is no. So it's less obvious to me that interest rates are going to rise than, if you like, recent history would suggest. But I think it's that expectation. I mean, some of your questions have alluded, if you like, to the fact that gold is probably a less productive asset for an investor in times of positive real interest rates. Got interest rates there, got inflation there, positive gap between them. Good for financial assets, probably not good for gold. On the other hand, the reverse is true in negative real interest rates. So I think there's that expectation that we're going to return to the status quo ante, if you like, of inflation at that and interest rates at that, and that's a bad thing for gold, and therefore I think that's caused investors to sell, if you like, ahead of that expectation, and I think that has been a lot of the reason. And of course, you also had the tapering of quantitative easing in the US, so that was less of a tailwind behind gold, but I think that process has gone too far, and as I say, I think the risks and opportunities are now asymmetrically placed, and I don't think it's going to be as easy for the future to play out in that way that we expect. You know, if you like, the analogue would be with the early 80s, where the US did put up interest rates to defend the value of the dollar, which was then heavily under pressure, partly as a result of negative real interest rates, and that started a 20-year period of negative returns from gold and positive returns by and large from financial assets. And I think the world is anticipating that, but I think they may well find that they're wrong.